Bond yields were all over the place with the uncertainty over tariffs, inflation, and the economy. So what happens now? Let's ask Bob Micehele. He's the Chief Investment Officer and Head of Global Fixed Income, Currency, and Commodities at JPMorgan Asset Management. And Andres Garcia-Amaya is also with us. He's here on set with me, and he's founder and CEO of Zoe Financial. Andres, I'll just start with you, and you can kind of bring the China. You're just listening to that interview with Derek there. Explain how you think this all kind of moves forward from here from a market point of view. Well,
one, no news is good news when it comes to auctions. I mean, we had our scares recently, but that's obviously a positive for the markets. It's a high-functioning fixed income treasury market. And putting it together with China and tariffs, I think the market went from only focusing on tariffs to now saying it is important, but it's not the only thing that's driving action. Economic numbers, the hard numbers, are actually holding up just fine. So that story continues. And earnings are holding up. In fact, EPS levels are back to where they were prior to April 4th. And I think that's not surprising that the markets are where they are now on the equity side.
We're back. I'm going to just call we're back to all-time highs. I mean, what's 1 or 2% among friends? Incredible snapback. And that just clears the way for us to continue to piece together solid gains, or no?
I look at it this way, right? So the asymmetry of returns is not as extreme as it was early April. And I was here in the show saying, hey, look, the market crashed really quickly. Historically, they tend to bounce back pretty quickly. It happened actually quicker than it usually does. And now then it becomes a question of if the economy, the hard numbers continue to be okay, if inflation, I mean, we had a good print, if we continue to see prints like that, and earnings continue to deliver, the momentum's on the upside. Maybe not the same asymmetry of returns, but it does have that momentum going forward.
And underpinning this momentum, Bob, has been a helpful drop in bond yields off of those highs that Rick mentioned. And why do you think that is, and do you expect them to continue falling?
Well, I think today was a pretty good day where you actually couldn't have a better day. We woke up this morning and it looks like China, U.S. are coming to some sort of agreement. The bond market always gets worried about escalation and what that would do to inflation. The CPI report that you referenced was fantastic. You had tremendous moderation in core goods and services. So the market liked that. And then lastly, to top it off, you had Treasury Secretary Bessent catch a 4 a.m. flight back to the U.S. just in time to bicker with Congress. It doesn't get better for a bond investor.
But when you say it doesn't get better, does that mean yields can't get lower from here?
No, they can get lower, and I think we're going to see that, particularly in the long end. The front end of the curve looks a bit overcrowded to us in terms of positioning. You've got 2-year yields below 4%. You've got the Fed funds rate at 4 3/8, and in the long end, you've got the 10-year at 4.42 and the 30-year around 5%. We expect the 30-year auction to go well. It didn't surprise us that the 10-year went well. The problem auctions for the Treasury have been the 20-year and the TIPS auctions. So all of this is good news. We would expect the long end to catch up to the front end.